Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to recap the jobs data, also some central bank rate cuts from this week, talk about some moves in interest rates, US dollar, as well as the continued volatility in commodities. We're chatting with Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark II Market website, which I will post in the show notes. Mark, let's start off with the jobs data. Headline number was very strong, almost 100,000 above estimates. The unemployment rate rose only by 1/10 to 4.0%. We also saw some stronger wage gains in terms of hourly earnings that were 1/10 higher than the consensus estimates. So overall, it's being viewed as a strong jobs number. The markets were down to open the day, but money's come back in. Overall, let's talk about that jobs data. Mark, dive under the hood for us. What did you read into this?
Yeah, I think you're right. The jobs data is stronger than most people expected. We've had a series of soft real sector data in the U.S. So this number, the reason that the non-farm payrolls number is so important, it's the first major number for a month. And much of the other monthly activity, like retail sales, for example, industrial production, these numbers will be generally likely to be stronger after the strength of the jobs data. But I would say that what I point out is that Powell has said that there's one number that captures the inflation for the Fed. What number captures price pressures? PCE, headline deflator. He says there's no such single number for the labor market. So it requires all those dimensions you were talking about: unemployment rate, participation rate, earnings. But what has spotted some people here today is that the non-farm payroll, which is achieved by getting a survey of establishments, a business survey, showed 272,000 increase. But when you survey the households, and that's what generates the unemployment rate, the households reported a loss of about 400,000 jobs. So what happens is these numbers are very noisy, but here's what it looks like. Over the past year, the U.S. has created about 2.7 million jobs by the establishment survey, but it's only created about 400,000 jobs by the establishment survey. I think that the takeaway from this next week at the FOMC meeting is that the U.S. labor market remains resilient, but it's gradually slowing.
Well, Mark, to that point, if it's gradually slowing, but it's still pretty resilient, and most people would say that, if they're just looking at the headline number, it's a pretty strong report, it beat expectations. It doesn't seem like there's any impetus for the Fed to start cutting immediately, and everybody's looking at the rate cut cycle because what we have seen is a flurry of other central banks ahead of the Fed in cutting rates. We just saw a couple of those this last week. So could you maybe speak to that environment? Everybody focused on when the rate cuts will happen. How does the job number play into that? How do the other central bank actions play into that?
Sure. So you're right. What we saw this past week, the ECB cut rates, 25 basis points. Denmark cut interest rates. They track the ECB pretty closely, and the Bank of Canada. So that means that we've got 5 out of the G10 central banks to cut rates. But the Federal Reserve does not follow the lead of other central banks. More the case is that other central banks follow the Fed. And even when the Bank of Canada cut rates, they said there's only so far we could stray from the Fed. We haven't exhausted that space, but it is limited. My best guess is that the Federal Reserve is in no hurry to cut interest rates, that the importance of this coming week's meeting is that the Federal Reserve is not going to change policy, but they will update their what's called a summary of economic projections, which if you use that in your search bar on the internet, you can find the Fed. It's published every quarter, and it gives you the Federal Reserve's median forecast and the range of forecasts for a few economic variables. But the important one next week is not so much on the economy, but Fed policy. Back in March, the last time they did this, they had the median dot was for 3 rate cuts, but it was a very close vote. They're very closely distributed, I should say. 9 of the 19 officials had 2 cuts or less. 10 officials had 3 cuts or more. And so I kind of think that Powell then cast a deciding vote. And so I think that's just the way it worked out. But I think this time, given the commentary we've had, given the economic data we've had, I suspect that the median dot goes from 3 to less than 2. And the market's already there. The market, before today's jobs data, the market was pricing in almost 2 cuts. But after the jobs data, the market has scaled that back a little bit, and now it's closer to 1.5. So I do think that we're moving towards a Fed cut. I'd still be penciling in one for this year. But I was in that camp earlier this year that thought there could be more cuts. But the economy's proven more resilient and inflation a bit more stubborn.
So, Mark, with the maybe change in the Fed's dot plot, albeit just coordinating to where the market is it market moving for the indexes, for interest rates, or even on the currency side of things?
Yeah, so I kind of think that sometimes no news is news for the market. We've seen this so many times now where the Federal Reserve statement is one thing, the market reacts one way, and then when Powell begins talking, the market reverses itself. So I'd say if you're faint of heart or if you're short volatility, next Wednesday, when we get the CPI number, and then a few hours later, the Federal Reserve, and then an hour or a half hour later, the press conference, it could still be a volatile day, even if they do what's as expected.
Well, Mark, when you look at the market's moves, even today, after the jobs number came out, there was initially a sell-off, and then it was bought right back. It seems like there's a lot of strength in the markets, several indexes hitting all-time highs again this week, several stocks like NVIDIA hitting all-time highs. Seems like there's a lot of strength. Is there any economic data that you see on the horizon besides next week that could change the direction of the general markets?
Yeah, I'm not sure how much the market's really the equity market is really driven by the economic data. On one hand, we'd say strong economy should be good for profits, strong for earnings, and yet we saw the U.S. economy slow down and downwardly revise Q1 GDP. So I don't know. I mean, I think that when I look out, I sort of think of this sort of broad pattern. April exaggerated the weakness of the U.S. economy. May, it's going to bounce back. And for me, the second quarter will be determined in June. But I don't see how this dynamic is going to change based on sort of our current information set. And when you think about the economy, what a scare the market had. The week began with the Atlanta Fed downgrading its assessment. They have this tracker which sort of thinks about the GDP as really an accounting function rather than forecasting. So as economic data comes in for the quarter, its model becomes better as it has more data. And so the began the week a little bit below 2%, having cut below from over 3%, it came down below 2%. And now in the last couple of days, it's back above 3%. So I'm in a camp that thinks the U.S. economy is slowing. It's slowing gradually. We don't get a recession this year. Maybe it comes next year. There's signs of weakness sort of below the surface. Disposable income, the discretionary spending, stress levels of debt holders. So I'm in the camp that thinks it's slowing, but it's slowing gradually. It's really a question of, to me, in the short run, market positioning. And we know that the market came into this with in the futures market, the non-commercials, a euphemism for speculators, were short the dollar. And we've gone through some levels. The dollar index had taken out a trend line that began last December, went through caught the March lows and the May lows. We went through it. People got excited. The big tops in place. And with the jobs data today, we come roaring back through the trend line.
Mark, what's your thought about these comments on stagflation being in the U.S. economy, or at least us going further down that road?
Yeah, I sort of like what Powell said at his last press conference. He doesn't see the case for stag. He doesn't see the case for inflation. And the sense that the economy is growing. Even if we assume what we grew in Q1, we're going to repeat in Q2, sub 2% growth, we're still growing close to what the Federal Reserve thinks is the potential, is the non-inflationary potential for the economy. And I'm in that camp that thinks inflation is slowing down. That if you think about the breadth, how many parts of the basket are above 2%? How many parts of it are below 2%? I think that it's really narrow now. It's keeping us above 2%. And so I think that we don't have either one of those are the problem. And I'm beginning to warm up to this idea. I think we joked about it before. Is that what's a soft landing? The soft landing is the end of one business cycle, and before you get to a recession, that period in between the end of a business cycle and a recession, we're in that soft landing now. These are the good old days.
Well, I want to get your thoughts on what you said a second ago, Mark, and that was about the dollar, everybody expecting it to weaken, and then it comes roaring higher through the trend line. Do you think any of that is a result of some of these moves by other central banks, or is it confidence in the U.S. economy and the markets continuing higher? Because most people were expecting the dollar to continue weakening this year, and instead it's been resilient, and now it's blasting back higher again.
Yeah, so I was in that camp too. I mean, so here's what happened, right? We have a big dollar sell-off in Q4 last year as the market began pricing in very aggressive Fed cuts. Remember, the market, even as recent as the middle of January, pricing in more than 6 Fed cuts this year. So the dollar fell. And as U.S. interest rates recovered and the market pulled back from that aggressiveness, the dollar came back. And actually, May was basically the first month of the year the dollar fell. And so I think people are looking for continuation of that. But I sort of would think of it like this, that the foreign currencies, leaving aside the yen, thinking more about like the euro and sterling, the dollar index. The euro and sterling sort of bottomed in mid-April, and they've been trending higher since then. So it's like whether it's 3 cents in the euro from 106 to 109, or a nickel in sterling. Now these moves seem stretched to me, and I was like resisting it. And I know that we need to respect, as traders, market participants, we need to respect the price action. And so last week when we spoke, I was looking for the dollar to begin recovering, but it was a very frustrating early part of the week. We didn't really get any satisfaction until today. And I think that, to me, this is the end of this leg up in the foreign currencies, or the leg down in the dollar index. And we went a bit further than I thought, but I think that it's not so much what other central banks are doing. The thing about this is that one of the things that I find tracks the euro, or is a good guide to the euro, it's not always a good short-term trading tool, but just a general trend, is the U.S.-German 2-year interest rate differential. That was about 200 basis points, the U.S. premium over Germany, say in May. And even after the ECB cut rates, the U.S. premium fell even further, briefly dipped below 170 basis points for the first time in about 3 months. So why did the dollar fall? Why was the dollar heavy? Why was the dollar weaker than I thought? That interest rate differential, as U.S. rates were falling faster than German rates, even though the ECB cut interest rates. And I couldn't get my head around it. I thought it was like, I'm hesitant. I've got enough scar tissue to be hesitant about saying that the market's wrong. But I needed to hold out till today's jobs data. And that requires money management more than necessarily being right about something. But I do think that we should be looking at gradually a dollar recovery in the coming few weeks. Maybe it lasts a month. We get to the next jobs data.
Mark, let's also tie in commodities here, because commodities have been so volatile. You know how we like to talk about them, but gold, copper, silver, they've all been volatile. Natural gas, that's had a strong uptrend recently. Oil, at least, has been range bound. But in terms of precious metals, the weakness that we're seeing today, is it mostly dollar based? Is it interest rate based? Or is there something more at play?
Yeah, so maybe let's begin with gold. Gold's kind of fascinating, huh? I think this is what happened. The market was looking, ahead of the jobs data at a weak U.S. dollar, soft U.S. interest rates, and gold was doing fairly well. And then, early today, the Asia Pacific session, this is as gold was basically making like a new high since, 2-week highs or so, got up to almost 23.90 in the spot market. China reported their reserve figures. And one of the stories I think that have encouraged people to buy gold is the idea that central banks are buying gold, and who's bigger than China? Well, the Chinese data showed that they were not gold buyers for the first time in a year and a half. The markets didn't know what that meant, except that one big buyer, it wasn't sort of, you're buying because you got the PBOC at your back. And all of a sudden, people realized PBOC wasn't there anymore. And so gold has reversed. We've got what I think is a key reversal going. A key reversal, technically, gold makes a new high for the move, so I say a 2-week high, and then it reverses lower and closes below the previous day's low. Well, yesterday's low in the spot gold market was about 23.53.5. We're trading now on the lows of the day as we're talking now near 23.03, 23.04. The low from early May came in around 22.77. And I think that the weakness in gold sort of matches what I'm saying about the dollar strength and higher U.S. interest rates. I could see gold testing at 277, maybe goes down to 2,200 as the dollar corrects and U.S. rates climb higher. But again, this is a story really at least tricked by China not buying gold, PBOC not buying gold in the month of May for the first time in a year and a half. What I like about the currency market is that the dollar is sort of the base of it. And so it's often a dollar story. But when it comes to commodities, I think it's sort of like what what Tolstoy said about families, that unhappy families are all unhappy in a different way. And so I kind of think that the commodity story all a little bit different. But I think that China, if China is partly responsible, what's happening in China, responsible for gold, I think it might also have something to do with the sell-off in copper. Of course, the speculative market, bullish on copper with the AI and the electricity demands and all those, that whole story. But it seems that people are more concerned about the Chinese economic slowdown and the rise of inventories in the Chinese ports. And so I think that might have also like tricked the top for copper. And so we're seeing even copper today pushing down to basically making new lows for this move here. I'm looking at the July copper, which is down there about 447. And remember, it peaked around the middle of May at 520. So this is a pretty big setback for copper. I suspect it's got a little bit more of a ways to go. I'm looking at something closer to 420, 425.
Well, Mark, as far as the unhappy family being unhappy for different reasons, let's also talk about silver. It's stuck in a tug of war between gold and copper because it's part precious metal and it's also part industrial metal. You'd mentioned you thought the solar market played a part here.
Yeah, there's talk that among the different components in solar panels of silver, and there's talk, because of, an amazing story about what China has built, went online this week, is they have established like a solar farm that's essentially the size of Manhattan, something like 200 acres. But the idea is that because of the tariffs and different issues, solar panel production is weakening, especially outside of China, due to competitive pressures. And the silver is one of those components. So some people were linking the weakness in silver to maybe a weakness in the solar panel sector.
What else could be driving silver, though, here, Mark? It's volatile. And I guess to that point, is volatility good for silver? Does that bring in more traders, more investors?
Yeah, I don't know. I mean, I don't have a lot of clients that trade silver, but I think in general, two types of clients, I think. Those who are sort of like vol junkies, who like volatility, because in a volatile market, one, you can make more money, even though you could lose more money, and it's sometimes more forgiving. Maybe your entry point doesn't really matter as much or something like that. But then there's people, I think, who prefer more stable markets, say a range-bound market where you buy low and sell high. And so I think there's so many different market segments. I find that among our corporate clients, when there's a lot of volatility, like to say that there has been this past week in Mexico after the election, the peso is off more than 7% this week. And that brought in a lot of client business, needing really to buy Mexican pesos to service their local entities down in Mexico. So yeah, I mean, I find personally as an investor, I find a little bit of volatility is good, but it's one of those things where too much of a good thing is really dangerous.
Well, Mark, just following up maybe a different angle in the commodity space here. A month or two ago, the narrative in the media and almost everybody we talked to in the commodity sector was that we're in a reflationary period because everything was going up. It's not just a gold and silver and copper story, but aluminum was going up and had a breakout. Zinc prices were the highest they'd been in a year or so. Nickel prices were finally clawing their way off the bottom. I mean, it was across the board. And then nat gas started moving along with it. Now we've seen the reverse where it's not just gold and silver and copper that corrected, but aluminum is down. Zinc is down. Nickel is down. Is it something more going on than just China and just, some of these individual supply demand drivers? Is there something going on in the commodity sector that we should make note of?
Yeah, I don't know. I know that dollar direction often plays a role as well. I don't know. The nat gas story caught my eye too, partly because what sparked it seemed to have been some Norwegian facilities going offline for unscheduled maintenance. And this initially caused a spike in the European benchmark from the Netherlands, but we're finishing the week lower on the week in the Netherlands, but we're still up over 10% here in the U.S. nat gas. So I don't know. My sense is that when I think about commodities broadly, I think about demand, and of course, there China plays a big role. Think about supply, and that varies, of course. And copper and many of those metals you mentioned seem to be highly concentrated in a handful of countries. And then I also think about the broad direction of the dollar.
All right. Well, Mark, I guess next week there's a lot again for us to look at in terms of that inflation data and the Fed meeting. And because it's that quarterly meeting, right? The dot plot, seeing what we get from them. Boy, oh boy, it's sure been interesting this week with all the volatility. And even as we were talking, some of these markets dropped quite quickly and they're rebounding a little bit now, but they didn't have those gains anymore for the day. It's just an interesting market here where still, there seems to be a lot of uptrends, but a lot of questions around those as well, always with the economic data and what central banks are going to do. However, the theme is it seems like rate cuts are here. They just will take some time to continue to process through. Mark, thank you so much for your time. As I mentioned, we'll post the Mark to Market website in the show notes, and we'll chat with you next week. Mark, have a great weekend.
Thank you. Good luck to everybody.